Welcome back, Venrate. When you retire or slow down from work, how do you know which account you're going to start pulling from to get your income in retirement? And how do you know the order from which you should be pulling from your different accounts? Let's talk about some tax strategies that keep more of your money in your own pocket and out of the IRS's greedy coffers. Before you watch the rest of this video, make sure that you at least broadly understand the three main tax classifications for accounts. There's taxable, tax-deferred, and tax-free accounts. And here's a little chart or guide that you can stop the video on if you need to refresh yourself. My take on this topic is somewhat unique in the financial community. I feel like most advisors are somewhat at consensus that you should pull from your taxable accounts first, so like your brokerage and your bank account. Then you should pull from your IRAs, and then you should pull from your Roth accounts, or in other words, taxable, tax-deferred, tax-free. I agree with Roth being last. The part that I differ from the broader community on is that I don't think that most people should pull from their taxable accounts first. And there's a lot of reason for that. Your tax-deferred accounts are like a big tax bomb that you have to deal with at some point. You've got to defuse it one way or another. It becomes an albatross where it's great that you have all this money saved up, but you're going to be withdrawing it at the least favorable rates in the entire tax code. Not only that, but once you reach your mid-70s and you have to start taking required distributions, then money's going to be forced out of your pocket when you may or may not need it. And that creates a massive tax problem that a lot of people don't see coming. So in my mind, the number one priority is getting rid of these IRA accounts. You need to either spend them or convert them, but you have to have a plan in place. And the other big reason that I think that you should focus on that first is because taxable accounts, like your brokerages and bank accounts, they have this beautiful line of the tax code where in most states, depending on where you live, has different regulations for it, but depending on how your state treats property ownership in a marriage, a lot of the time when somebody passes and leaves behind assets, the person receiving them gets an adjusted cost basis. And to clarify, beneficiaries always get an adjusted cost basis. It's specifically within a marriage that, based on your state's laws, will determine how much of that property you already owned prior to their death, and therefore how much of an adjustment of basis you are eligible for. So what does that mean? Well, let's say that you have a grandpa that is so old that he was able to buy shares of some company for 1 penny and 1 smooth rock per share back in the Neolithic age, okay? And he hasn't sold this stock because it's appreciated so much and he didn't want to have to pay capital gains. Because remember, you have to pay capital gains on the difference between what you paid for it and what you got for it when you sold it. And since the stock has gone up and up and up, well, he doesn't want to sell it because then he's going to have to pay tax on a greater amount. Again, this is dependent on the state that you live in, how the laws work. But here in Texas, if I were to be left assets that my grandpa bought for 1 smooth rock and 1 penny in the Neolithic age, I would get a full step up in cost basis with no limit. And my new cost basis in the stock that I inherited from my grandpa would be whatever it was on the day that he died. And the same is true for husbands and wives. And that is a killer tax break. If you're savvy with this kind of stuff, you may be thinking, well, yeah, it's great to save money on taxes, but as far as the tax code goes, capital gains tax is pretty gentle. Most people pay 15%. And that is true. But the other thing that people fail to consider is if you die and you leave behind a widow or a widower that is now paying single taxpayer rates, and they have to take all of their income from an IRA, it makes things so much worse. I see a lot of people that don't want to pull from their IRAs or they want to defer it as long as possible because they're scared of paying the taxes. And justifiably so, I get it. Nobody wants to pay taxes. And if you can kick the can down the road a little bit longer, most people would. But the problem is, when you do that, and you're married, you are actively making it harder for your surviving spouse to live and to manage their finances in the wake of your passing. When one spouse dies, even though the number of people in the household has just been cut in half, it's very rare that the expenses of the household are also cut in half. You still have to pay for the house, you still have to pay the same bills. It's very rare that you can cut your expenses perfectly in half. They will go down, but not nearly by a half. In most cases, maybe a quarter or a third. And so on a per person basis, the household needs more income. The number of people in the household went down by 50%, but the spending of the household, or rather the income need of the household, did not go down by a commensurate 50%. And so you're exacerbating the tax problem. You're making it worse when you do that. So what are some things that make this more difficult? Well, if you've worked at a lot of places over the years and you've accumulated a lot of different account types, if you've got 401ks all over the place and your partner has 403bs and all this random stuff, you'll want to work on consolidating it because that makes things so much easier. It doesn't make a big impact on your financial plan, but making the financial plan becomes so much easier when you do that. If you've got rental income, if you're managing rental properties and you've got income coming in, that changes the calculus quite a bit because it might not be as worth it for you to be doing Roth conversions if you know that you're still going to be having a lot of income in retirement. And the same is also true for pensions. If you've got payouts from a sold business, if you've got income coming in that you're going to be taxed on, that changes things. If the stock in your taxable accounts is not highly appreciated, if there wouldn't be a lot of capital gains to pay anyway, then it might not be worth it to employ this strategy. And also, if you have losses built up in the account, then it's probably definitely not worth it to employ this strategy because you would actually lose out. Because a lot of people think of the rule as being a step up in basis, but really it's a step up or down. The cost basis of the asset just gets adjusted to whatever it was on the date of death. So if you purchased it for a higher amount before than it was at the date of death, you could get your cost basis stepped down, and that would actually hurt you. Also, depending on the amount that you have saved up in IRAs, right? Depending on how bad your RMDs are going to be, for a lot of people, if you've been diligent about making prudent financial plans your whole life, you might not have that much in IRA that you need to deal with. And in that case, the required minimum distributions might be fine to just take those because that's the same amount of money that you would be spending anyway, right? You don't just have to convert just for conversion's sake. You only convert to the extent that you can save money on taxes. And if RMDs wouldn't push you into a higher tax bracket involuntarily, if you're going to spend that money anyway, then you might as well just take the RMD. And I can't stress enough that with this topic specifically that we're talking about here, most of the benefit will not be during your lifetime. The lion's share of the benefit will be to the people that you leave behind when you pass. One common pitfall that I see is people who are in their later stages of life have a lot of money saved up in IRAs. They're spending from their taxable accounts first because they don't want to pay the tax bill. And when they pass, they leave all this IRA money to their beneficiaries who, at that point, might be in their 50s and 60s. They're probably in their highest earning years. They're probably in a fairly high tax bracket. And you got to think, if you have a son or daughter that by that point is an executive or something, and they're making a lot of money, well, now they have the added burden, in air quotes again, it's a good problem to have, but they have the added burden of now suddenly they have to take their own required minimum distributions from this IRA that you left them. Depending on the situation, changes the RMD setup, but if they have to be taking distributions from this inherited IRA while they are in their peak earning years and are at a high tax bracket, then they are losing more of the money. All this money that you tried to leave for them, they get to keep less and less of it because as their income is being driven up by this unintended income that they have to take, then they're being taxed on a greater percentage of it. And so less and less is being left with them and more is going with the IRS. Thanks for watching Venrate on YouTube. I hope you enjoyed this video. If you have any questions, feel free to leave them in the comments and be sure to check out venrate.com for the world's best financial calculators and planning tools.